Welcome to Sakshi the Fun Factor. Today we are here with Sunil Maini. Mr. Sunil Maini, Certified Public Accountant PC, serving the Dallas-Fort Worth DFW metro area for over 20 years. They offer simple solutions for complex situations through their range of accountancy, business advisory, tax and payroll services. Whatever your financial status is, you will profit from their experience of financial advisors who will listen, understand and help you make the most appropriate financial decisions for you and for your business. So you can email them on mainicpa@mainicpa.com or visit their website sunilmainicpa.com. Before that, please note that if you are a CPA and would like to join our special shows, please email us at usa@sakshi.com or call us at 866-725-7441. Before we begin the show, please note that the information provided on this show is not legal advice and for general information purposes only. Sakshi TV or its agents will not be responsible for use of information. If you need specific legal advice, please contact the CPA directly. Welcome, Mr. Maini. I hope you're doing well, and please give us a basic introduction about what you do and your practices.
Sure. It was 31 and a half years ago, when I was 31 and a half years old, that I moved in from corporate America into starting my own practice. And since then, the one rule that I have maintained is that I will serve the client while making my wife become the first person that I serve. So first my wife, then my client's wife and children, then the third person that I serve is the client himself. And now I can do anything that is physically, mentally, intellectually available to do. And we will use all the loops that there are. It could be only 1 centimeter in size, and we will make a whole 18-wheeler go through it. But first of all, the first person we are serving is my wife. Then later, the second rule that I made in my practice was that if you have foreign accounts and you don't want to show them, then you are not going to be my client. And made a couple of rules only, not more than 3 or 4, and try to follow them the best I can. I serve clients from the local community, serve clients from abroad, and all the clients who have foreign accounts and as well income abroad, handle all those kind of tax returns. We are big into hotels and motels, because as you will know, about 55% of the hotel hospitality industry in the US is owned by Asian and Indian Americans mostly. And as well, we are very big in IT field, India being the world capital of IT. Automatically, we are very entrenched in our ways and in our ability to serve that community. We do tax returns for IT clients who have businesses in all 50 contiguous states of the United States and 48 contiguous states, and Alaska and Hawaii are not within the boundary. So 48 contiguous states we file returns. One thing I do tell my clients is, if you have nexus or presence in any state, they have to register over there. Had a good stint so far for the last 31 and a half years. We have 7 employees in our company. We do all our returns in the US. We don't get any returns done in India.
Yes.
That is one niche that I have built.
That is so great, Mr. Maini. It's very nice listening to whatever you said. Now, Mr. Maini, can you answer this question? Can you give us a review of the major business tax changes that have taken place, which will affect 2021 income and expenses?
The business tax changes that have taken that will affect. Now, can you tell me a little bit about the audience that is going to be listening to this? These are all Americans or Indians or Indian accountants?
I think in the whole Indian community from USA and India will be watching this show.
Okay,
Yes.
So I'll start with till today, till 2020, till 2020, only 50% of the business meals were deductible. Starting 2021 and up to 2023 starting, so December 2021 and 2020 calendar years, the business meals, if consumed at a restaurant or when the meal was prepared at the restaurant, on site or off premises, you can take the food and eat. That is 100% deductible. I think that is because the pandemic hurt the restaurant industry a lot, and so now to make sure that the restaurants prosper, the 100% deduction is allowed. For this purposes, the restaurant is a place where food is cooked and provided for immediate consumption, whether done on premises or off site. That is the definition of a restaurant. A food store, a grocery store, a liquor store, those are not restaurants. And that is one from 50% to 100% deductibility is available. For those partnerships that have rental properties, the property age is now increased reduced from 40 years to 30 years. And for the 2018, 19 and 2020 returns, if the 40-year depreciation was used, then the returns will have to be amended. And an automatic Form 3115 application for change in accounting method can be used, or you can use an administrative adjustment record, AAR, for making the change in the 2021 return itself. So both options are available, whether you amend the returns or for each year, or you make the change only in 2021 return. But all the K1s will be affected for all the partners, and that change will have to be included in the 2021 return that is going to be filed. Then the third thing that has happened is the employer credit for paid family and medical leave only pertains to COVID-related sickness that happened, and you can claim a credit for 12.5% of the wages that were paid up to 50%. And if you paid more than 50% to the employee, then another 0.25 percentage is available to be deducted for the credit to be not more than 25% of the wages paid. The fourth mention that I should make is that if you received an advance for economic injury disaster loan, it's called the EIDL loan, EIDL loan, then that is non-taxable income. It is income, has to be reported, but it is also tax exempt. That is the fourth thing. The fifth thing is, if you received as a restaurant any grant towards the revitalization of the restaurant, then that also is to be reported as income, but it is non-taxable. That means it's tax exempt. Reported as income, but tax exempt. If you deferred, if there were businesses like restaurants that could not afford to pay the employer and employee taxes, and they deferred those taxes, if you did defer them, then the IRS is saying that you can, when paying them those taxes, please record the trust portion of the taxes as paid first. Otherwise, the application will be to the penalties and interest were you to be late. So our recommendation to our clients is record the deferred taxes as paid towards the trust taxes. The trust portion is the Social Security and Medicare and the federal withholding withheld from the employees' portion of the payroll. That has to be paid first. Also, there is a HSA, the health savings account, and health reimbursement arrangements, 3650 by the individual and 7300 for a family coverage towards health savings accounts that you can have. The next big change that has happened is like-kind exchanges could be done for any property that was like-kind between the buyer and the acquired property and the property that you were giving up in the exchange. That has now been, the 1031 exchange now has been limited to only real property. So that is a huge change that needs to be, one should be very cognizant of. So IRS has provided a safe harbor for the first round of PPP loan recipients who filed their 2020 taxes before December 27, 2020. Now, the question would be, who would file a return before the year ends? And the answer is, there are fiscal year individuals and entities that were not able to deduct the expenses against the PPP loan that they had received, because it was not law yet that you can deduct those losses. So now the law has been passed that the PPP loan itself, the Paycheck Protection Program loan grant that you received, is non-taxable income to be reported on the tax return, and also the expenses that the PPP loan paid, those expenses are also deductible. That helps the taxpayers to increase their equity in the business, but that is something that the IRS or the government, the Congress wants to happen at this time to safeguard the businesses' continued success or continued to stay in business. The final regulations have come for the small business tax accounting and long-term contracts. A small business is considered a business that has revenues of less than $25 million. And for 2021, it will become 26 million. If you are less than $26 million in sales, you are a small business. And that is adjustment for inflation. And also, if a contract starts in, let us say, October and finishes in October of next year, because there is a year change, it is called a long-term contract. If there is a long-term contract, then the income received for October through December has to be displayed in the current year, and the income for January through October of next year will have to be displayed in next year. So the long-term contract regulations have changed, that current year income will have to be reflected in the current year. Now, going back for a second to the meals and entertainment expenses, if the meals are lavish, then the deduction will be disallowed. Now, lavish means if the place you are at, you are getting the food from that place, then that is not considered lavish. For example, if you are at a local restaurant but order your food from a 5-star, that is called a lavish charge or expense, and that will be disallowed. However, if you are eating 5-star food at a 5-star hotel, then that is not lavish for that time. So also the IRS, by removing the words another person or persons at the beginning of the final regulation, has added the phrase that if the food is being served to the taxpayer or while the taxpayer is present, then the deduction will be allowed. That's a very small change, but very has many big repercussions.
Yes.
So therefore has to be mentioned as a change. So now if the taxpayer is taking from the company both a W-2 and a 1099, then that why a 1099 is being issued to a W-2 employee has to be answered by saying that you have taken a bonus, because otherwise the IRS is now looking at those returns that issue both a W-2 and a 1099 to an employee of the company or to an officer of the company. Also, I already mentioned 100% deduction. So those are the business changes that have taken place in the last regulations that were passed. Latest was in September 2023.
Yes.
21, September 21. Yeah.
Yes. So, Mr. Maini,
Yes.
you're telling me that the meals deduction being 100% for 2021 and 2022. Can you give us? You gave us an introduction. Can you give us a little bit more information about it?
Food has to be consumed that is sourced from a restaurant,
Okay.
not a grocery store or a food store. The meal cannot be termed as lavish by the government. Therefore, that has to be watched out. And those are the main two items that every businessman needs to understand. The food has to be not sourced from a Walmart or a local store. Not a food store is not a restaurant. That is one thing that has to be
Yes.
identified. So I wanted to repeat that
Yes.
when I
Yes.
asked that. Yeah.
Yes, Mr. Maini. So again, we have been hearing a lot of in the news with regard to sick pay and medical leave. Can you differentiate and can you tell us more about this situation?
Yes, sick pay is allowed in the new Congress law that was passed by Congress. Senate will not pass it, is my reading of that. But they have passed $205.8 billion in the next 10 years towards medical leave or sick pay. So medical leave is when the new mom or the new dad take time off to take care of the child. That's and sick pay is when there is a COVID-related sickness that is caused. And so if in the scenario where the sickness is caused by COVID for right now, for 2021, the sick pay and the medical leave are only for COVID-related sicknesses or leaves. Uh, the government is giving a credit for up to 12.5% paid to the employee as salary for the first 50%, and in excess of if the employee was paid over 50% of their salary, like let us say I make $10,000, and then in most scenarios, let us say the employer paid only 5,000, then the credit is 12.5. But if the employer continued to pay me the $10,000 that that is my monthly salary, then for every $1,000, the increase is 0.25 so that the credit can be up to 25% of the total salary paid, but not exceeding 25. And the medical leave or the sick leave can be only for 12 weeks in a tax year, not more than that. And this law is extended up to 2025 tax year,
Okay.
calendar year. So those are the
Yes.
changes that are.
Yes, Mr. Maini. And also, Mr. Maini, it was noted that the triple P loan recipients who did not deduct 2020 expenses in 2020 can deduct those in 2021. Is it because they did not deduct the expenses in 2020, or what else is the answer?
Yes, those taxpayers who filed on fiscal year accounting were not allowed to deduct those expenses because it was not known whether the expenses that time the Congress had not given the final regulations that the expenses will be deductible or not. So they had to file the return without being able to take the expenses during that fiscal year. Now the IRS is saying those expenses are deductible and can be taken in 2021 for the 20, even though the expenses were made in the calendar year 2020. Mostly expenses and income of that year have to be deducted in the same year's tax return. In this scenario, the government has made a exception that the 2020 expenses can be deducted in 2021.
Yes. Okay, Mr. Maini, we have mentioned the changes with regard to businesses. What are some of the major changes for individuals?
Last year in 2020, the government at the very last minute allowed a 300 deduction above the line, above AGI, the adjusted gross income, for charitable contributions that were made towards funding for the temples or churches, or any non-profit was given funding towards buying masks and other sanitizing expenses that they had. So the taxpayer could deduct up to $300. That amount has been increased for the 2021 calendar year to $600 that can be taken above the line. There are a lot of taxpayers, Shivani, who are not able to claim their charitable contributions because the standard deduction is 25,200, and the mortgage interest, property taxes, etc., are not greater than 25,200. So for all taxpayers now, up to $600 of income is allowed for this year. The
Yes.
second one that I really want to highlight a lot is the identity protection IP pins, personal identification numbers. The IP pins, the IRS has now announced that all taxpayers are eligible to obtain the IP pin. It's a 6-digit number that will be changed, renewed every year, and it will be mailed during Christmas time. Um, and you should provide it to the CPA preparing your return, or whoever prepares your return. The IP pin or the electronic filing of that return will not be accepted. The purpose of this is to there's too much fraudulent tax return filing that is taking place, too much identity theft that has been taking place, and the IRS wants to limit that. And so if the IP pin is available, then the IRS has a double verification mechanism of Social Security number and the IP pin that they will issue to the particular taxpayer.
Yes.
And the IP pin can be obtained by going to irs.gov/IPPin, and there will be about 7 or 8 questions that they will ask you with regard to some mortgage loan that you have, or an insurance loan that you have, or last 4 digits of the credit card number, or and date of birth, and they will try to easily figure out who you are and if you are the right person, and if that information matches with it shows you the reach of the IRS, that they know how much about you, and the IP pin will be issued, and you don't have to file the form 14039 to obtain the IP pin anymore. That used to be the case when there was an identity theft and the affidavit form was 14039. That doesn't need to be filed anymore.
Yes.
And you can file it for the number without having the identity theft also. So,
Yes. Yes, Mr. Maini.
the, so the
Yes.
next major change, Shivani,
Yeah.
is the IRS served John Doe. John Doe means any name summons related to cryptocurrency use.
Yes.
So the federal court in Massachusetts on April 1st, 2021, authorized IRS to serve a so-called John Doe summons on a Boston-based digital currency exchange, Circle Internet Financial Inc., and its predecessors and its subsidiaries and divisions and affiliates, including Polonix LLC. So the purpose of that was, if you have had transactions of more than $20,000 between 2016 and 2020, the IRS wants to identify you, whether you have reported your entire income or not. And quoting the IRS, because transactions in cryptocurrencies can be difficult to trace and have an inherently pseudo-anonymous aspect, taxpayers may be using them to hide taxable income from the IRS. And so 2 new terms, Shivani, have evolved in the last 4 or 5 years. I think 7 years ago only the cryptocurrencies were introduced to the world.
Yes.
And because it is very hard to trace them, 2 new words have been introduced. One is like a spoon, there's a fork. There is a hard fork. It's like a merger and acquisition or a stock split taking place.
Yes.
That's how it reads to me. There are 2 terms that have evolved. First is a hard fork, and it occurs when a cryptocurrency on a distributed ledger undergoes a protocol change, resulting in a permanent diversion from the existing distributed ledger. a hard fork can result in the creation of a new cryptocurrency. So if there is a merger of two companies and they took the name of one and gave up the name of the other, or gave a new name entirely, like for example, if Sunil Maini CPA merged with ABC Inc. And the name that survived is Sunil Maini CPA, then that or the name that survived is Sunil ABC Inc. So then it's a totally new name.
Yes.
Then in that scenario, a totally new currency is being issued on a totally new ledger,
Yes.
and the IRS is not able to trace them back sometimes. So they are saying if there is a hard fork transaction, there may be income that has been that has arisen, and that is being hidden from the IRS. And the second the word that has evolved is airdrop. It means it is a means of distributing units of cryptocurrency to a distributed ledger addresses of multiple taxpayers. In a 2019 revenue ruling, IRS looked at two cryptocurrency fact patterns. The taxpayer received units of cryptocurrency via an airdrop after a hard fork, which means the airdrop cryptocurrency was gross income. And as long as the taxpayer actually or constructively received the new cryptocurrency. As soon
Yes.
as you receive that currency, it became income to you. And if you don't reflect it on your tax return, that's a no-no for the IRS. And therefore the foreign accounts that are holding virtual currencies will now become reportable. According to the Financial Criminal Enforcement Network, financial is FIN and CE and Criminal Enforcement Network, FinCEN, notice the current FBAR regulations do not recognize a foreign account holding virtual currency as a type of reportable account, but they are seeking for that to be reportable now, and therefore if you have foreign accounts which have cryptocurrency, that will become reportable. And the IRS has made solid announcement that it intends to change the FBAR regulations to make the foreign accounts holding virtual currency reportable. And
Yes.
also, the new one thing for individuals, if the couple, if the married filing joint return made less than 150K, and during the year they were unemployed because of the pandemic, and they received 10,200 or more in unemployment income, the income up to 10,200 for both spouses is not taxable for 2021. So
Yes.
that law is for this year. So
Yes, Mr.
uh,
Maini.
only.
Yes.
And then there are other changes in law which will affect people who have income which is quite less. And I do
Yes.
not know if it'll apply to NRI, so I'll skip over that.
Yes.
But there is if you receive the third stimulus check, the
Yeah.
individual recovery rebate, which was $1,400 for each individual, including the dependents, then if your income was less than 150K for a joint return and 75K for a single taxpayer, then that income is also not it is tax exempt. It is includable in income, but not taxable income. So you
Yes.
have to show it. So when you go to the tax preparer this year, please take your the money that was received and the dates it was received during 2021.
Yes.
Also, the child tax credit has been expanded from 2,000 to 300,000 to 3,000 per child up to the age of 17, and $3,600 for a child under the age of 6. Again, if you're single, the amount is $75,000, up to which the child tax credit is expanded to. And for married filing jointly, it is up to 150,000 in income, and that is a way of government trying to ensure that the children are living, are having enough food and
Yes.
etc. So for those people who are living,
Yes.
in the middle class families. So
Yes.
and then there is a child and dependent care enhanced So if you have children who are going to daycare while you go to work, the limits for that have been raised for singles from 3,000 for per child from 3,000 to 8,000, and if you have more than two children or two children, the credit has been expanded, enhanced to 16,000 from the earlier 6,000, and the percentage that can be deducted is increased from 20% to 50%. So that's a
Yes.
pretty um, beneficial change for the taxpayers
Yes.
who were working and having children in daycare. And so
Yeah.
also, if you were a student and your loan was discharged, that discharge of the student loan otherwise would be income, but up to 2025, it is not going to be income for the student whose loans were discharged, whether from university or private education loans or any institution that had given a loan and discharged
Yeah.
it. Children who were attending college
Yeah.
or youth
Yes, Mr.
that
Maini.
were attending college.
I think we covered a lot of topics today. It was
Yes.
we actually covered so many different topics from foreign accounts to PINs. It was amazing talking to you. I hope the viewers have enjoyed the show. Thank you so much for joining us today, Mr. Maini.
Thank you very much, Shivani. Thank you
Yes.
to Sakshi TV also to
Yes.
host me. Thank you very much.
Thank you so
Take
much.
care.
I'm your host Shivani Raj, and you're watching Sakshi TV.